2 months ago, I released a two-part video about Sea Limited stock and made the investment case that the stock was severely undervalued at $40 a share. Nobody wanted to buy the stock back then, which is why I bought the stock. Well, there are other reasons such as strong fundamentals and outlook, but the point is, I bought the stock when few people wanted to buy the stock. And now that the stock is nearly $60 a share, everyone seems to want a piece of Sea Limited stock. So what is going on with Sea Limited? As it turns out, the company just reported Q4 earnings, and judging by the reaction in the stock price, I think investors really liked what they saw in the earnings report. So in today's video, I'll be going through the company's Q4 earnings results, what caused the rally, and what I think about the stock moving forward. As always, you can find the article version of this analysis in the description box below, and with that being said, let's look at Sea Limited's Q4 results. For those who don't know, Sea Limited is a Singaporean-based tech conglomerate that operates three core businesses, namely Garena, which is one of the largest game developers in the world, Shopee, which is the leading e-commerce platform in Southeast Asia, and Sea Money, which is a fast-growing fintech company. So Sea Limited was one of the most popular growth stocks during the early days of the pandemic, given the fact that the company was growing at triple digits for a considerable period of time. However, growth has slowed down significantly to just mid-single digits over the last few quarters. That said, Q4 revenue was $3.6 billion, up by 5% year-over-year for the fourth consecutive quarter. This actually beat analyst estimates by $70 million or 2%, which is one of the major reasons why the stock has been rallying in the last few days. If we take a look at revenue by segment, we can see that Garena, which is the gaming division, is still struggling with revenue of $511 million, down by 46% year-over-year due to lower user engagement and lower monetization. So personally, I was a little disappointed as I was expecting sequential growth in the gaming division, given that Q4 is typically a seasonally strong quarter. But instead, we get an 80 million sequential drop, which is not a good sign at all. Well, that's because quarterly active users were down from 544 million in Q3 to just 529 million in Q4. On the bright side, bookings were slightly up quarter over quarter, and quarterly paying user ratio remained stable quarter over quarter. So as you can see, things are not looking so good for Garena. However, management is seeing improved user acquisition and retention trends for Free Fire, which is Garena's most popular game, with over 100 million peak daily active users in February. Furthermore, they expect double-digit year-over-year growth in Free Fire users and bookings in 2024, so we can expect Garena's metrics to improve throughout 2024, so that's good news. Moving on, Shopee, which is the e-commerce division, was the star of the show. The company's revenue was $2.6 billion in Q4, up by 23% year-over-year, which was an acceleration from Q3's growth of 16%. I think this caught a lot of investors by surprise, given that the growth slowdown seems to be unstoppable over the last few quarters. That being said, this strong growth was driven by a 29% year-over-year and 15% quarter-over-quarter increase in GMV or gross merchandise volume, which was $23.1 billion in Q4, which is also a record high for the company as well. Also, just ignore this missing data here because management did not disclose GMV in those periods, which is why there's a hole in the chart. On the other hand, Shopee's take rate, which is revenue as a percentage of GMV, was 11.2% in Q4, down by 50 basis points year-over-year. This means that Shopee's monetization abilities are weakening. However, on a quarter-over-quarter basis, take rate actually improved by 10 basis points, showing improved monetization on the platform. In addition, management sees the potential for take rates to improve even further, which should drive robust revenue and profit growth for the segment. And last but not least, we have Sea Money, which is the fintech unit. In Q4, Sea Money produced $472 million of revenue, growing 24% year-over-year. As you can see, growth is slowing down rapidly for Sea Money, and this is normal as the company grows over a larger base. Regardless, Sea Money continues to expand primarily due to the consumer and SME credit business, which grew 27% year-over-year in Q4. All in all, a very strong quarter for Sea Limited, especially with Shopee re-accelerating back to 20% plus growth. More importantly, despite intensified competition in Southeast Asia, Shopee manages to gain market share throughout 2023, which is a testament to its strong value proposition and execution. On the other hand, C-Money is slowing down significantly, but I'm not too worried about it since fintech adoption in Southeast Asia is just getting started. The problem lies with Garena's lack of growth, which is dragging the entire business down. However, management seems confident that the gaming division can rebound in 2024, which should be positive for C Limited. Turning to profitability, Q4 earnings per share was negative 19 cents, beating analyst estimates by 7 cents. So this is another reason why the stock rallied after Q4 earnings. So Q4 net income was negative $112 million, down from $423 million last year, and this represents a net income margin of negative 3%, which was down 15 percentage points year over year from 12% last year. So net income turned negative in Q4, primarily due to the rapid growth of Shopee, which is a lower margin business compared to Garena and C-Money, as well as higher sales and marketing expenses, which grew 104% year over year to $967 million. As you may or may not know, C Limited underwent some restructuring and cost-cutting initiatives last year, which was why net income turned positive a few quarters ago. However, now that C Limited is a much leaner business, C is ramping up spending once again, especially in the marketing department, to stimulate growth and grow market share. As such, net income turned negative in the last 2 quarters. Adjusted EBITDA, which adds back non-cash expenses such as stock-based compensation and depreciation, saw a similar trajectory as net income. However, the metric stayed positive in Q4 at $127 million, which is a 4% adjusted EBITDA margin, but that is down 10 percentage points year over year from last year's 14%. If we look at adjusted EBITDA by segment, we can see that the overall profitability of the company was dragged down by Shopee, which had a negative $225 million adjusted EBITDA in Q4, which represents an adjusted EBITDA margin of negative 9%. Again, this was due to higher sales and marketing expenses, which grew 132% year over year to $879 million just for Shopee. But here's the thing, compared to the previous quarter, Shopee's sales and marketing expenses actually went up slightly quarter over quarter, but even so, Shopee's adjusted EBITDA improved 35% quarter over quarter, and adjusted EBITDA loss per order improved 43% quarter over quarter, which means that the company is gaining operating leverage, which means that there's a clear path towards profitability for Shopee, which is really good news. As for the other 2 businesses, profitability remains robust. For Garena, adjusted EBITDA was $217 million at a 43% margin. Adjusted EBITDA actually dropped slightly quarter over quarter due to lower revenue, but margins expanded 300 basis points quarter over quarter due to lower marketing expenses. For C-Money, adjusted EBITDA was $148 million at a 31% margin. As you can see, it declined slightly quarter over quarter, and this is due to higher sales and marketing expenses as management invested in user acquisition. However, on a year-over-year basis, you can see that adjusted EBITDA and the adjusted EBITDA margin are both expanding, showing economies of scale within the fintech platform. So overall, profitability is trending in the right direction for all 3 businesses. Shopee remains unprofitable, but that's because the company is ramping up spending again in order to grow market share. The company wants to strengthen its moats, and it definitely comes with a cost. The good thing is that Shopee has 2 high-margin businesses, namely Garena and C-Money, to cover its losses. But as Shopee scales further, I have no doubt that Shopee will turn profitable again, and once all 3 businesses are profitable, I think C Limited will be unstoppable. Looking at the balance sheet, C Limited ended Q4 with $8.5 billion of cash and investments and total debt of $4.4 billion, which puts its net cash position at about $4.1 billion. As you can see, the company's cash hoard has been building up over the last few quarters, and what did the company do with its growing cash balance? Well, the company spent a considerable amount of money on short-term investments and treasury investments for better cash yield management, which enabled the company to earn higher interest income in 2023, which was over $200 million more than in 2022. So basically, management is taking advantage of higher interest rates, leading to higher interest income, which is a major reason why the company turned GAAP net income profitable in 2023. That being said, despite ramping up spending in Q4, Sea Limited maintained positive operating cash flow at $279 million in Q4, representing an operating cash flow margin of 8%. Moving forward, I expect Sea Limited's cash balance and cash flow to expand even more over the next few quarters and years as the company focuses on profitable growth. In terms of the outlook, management did not provide formal guidance. However, they did list out a few things that we can expect in 2024, which I have summarized for you in this slide. So first, management expects 2024 to be another profitable year, which eliminated concerns about the sustainability and profitability of the business as a whole. Second, as mentioned earlier, management expects double-digit year-over-year growth in Free Fire users and bookings, so we can expect improvements in the gaming division in the next 12 months. Third, despite the slowdown for Sea Money, management expects continued robust growth in 2024 as the company continues to invest in its credit business, digital banking, and insurance services, given that they see a significant upside in the fintech market. And finally, management expects Shopee GMV to grow in the high teens in 2024. In addition, they expect Shopee to return to positive adjusted EBITDA in the back half of the year as the company benefits from economies of scale. So as you can see, very strong outlook given by management, which is also another reason why the stock reacted so positively after earnings. But analysts were still concerned about competition. More specifically, they were concerned about Tokopedia and TikTok slowing down Sea Limited's growth. As you may know, TikTok Shop was banned in Indonesia back in October last year, but then resumed operations in December through its merger with Tokopedia. So between October and December, Shopee faced less competition because of the TikTok ban, which is one reason why Sea Limited outperformed expectations in Q4. But now that TikTok has resumed operations, some analysts were worried about TikTok slowing down Shopee's growth in Q1 and beyond, which is valid. Competition is nothing new for Shopee, and not surprisingly, the first analyst question during the earnings call was related to competition. But I really liked how management responded to the question. I recommend you to listen to the earnings call, but to save you some time, management is not worried about competition because Shopee has really strong competitive advantages that will enable the company to maintain high market share. So according to management, Shopee has superior scale, leading to improved monetization capabilities and unit economics. They also have deep local knowledge and expertise, leading to stronger execution. Shopee also has a massive logistics network, enabling the company to offer differentiated services. Management is also confident that Shopee is the most price-competitive platform in the market, offering better prices for consumers. Shopee also has direct integration with Sea Money, which reduces transactional costs, enables cross-selling payment products, and increases checkout conversions. And finally, they believe they have better service quality in terms of logistics, customer service, live streaming, and so on. So all these create a much stronger Shopee ecosystem, an ecosystem that is capable of outperforming the competition and taking even more market share. On a side note, it seems that TikTok is not complying with local authorities, which could lead to another ban for TikTok, thus benefiting Shopee. In addition, management mentioned during the earnings call that they see similar growth trends continue in Q1 even with TikTok resuming operations, so investors shouldn't worry too much about competition. Whatever it is, I think Sea Limited's outlook is brighter than ever given Garena's expected re-acceleration in 2024, Sea Money's massive growth opportunities in fintech, and Shopee's leadership position in Southeast Asia. Looking at valuation, Sea stock is now trading at just 2.4 times its revenue, which is a significant discount from its peak of 31.8 times and its 5-year average of 10.9 times. So despite the 70% rally since its bottom a few months ago, C stock still looks extremely undervalued compared to its historical multiples. It is still trading so cheaply despite being a much larger, leaner and profitable company today than it was a few years ago. Based on 2024 earnings estimate, C Limited is trading at a PE ratio of 33.7 times, which is quite cheap since the company has just turned profitable and is still in investment mode. And keep in mind that analysts are expecting very strong earnings growth over the next few years at 124% in 2024, 69% in 2025, and 60% in 2026, which could lead to multiple expansion with these kinds of results. That said, I have a price target of $91 a share for C Limited stock, and this is based on the assumption that the company reaches $36 billion of revenue by 2033. This is just a 10% compounded annual growth rate, so this is quite conservative. I also expect 2033 free cash flow margin of 17.5%, which is conservative given that Mercado Libre, which has a very similar business model as C Limited, has a free cash flow margin of 32% in 2023. And based on a perpetual growth rate of 2.5% and a discount rate of 10%, I arrive at a price target of $91 a share for C Limited based on my base case scenario. And I've also included my bear and bull cases, so you can pause the video and take a look at them. That being said, a $91 price target represents an upside potential of 54% based on the current price of $59 a share. To wrap up this video, I think C Limited's Q4 earnings results might have turned around the stock for good. The company beat revenue and earnings estimates, and in addition, management provided strong outlook with strong growth and profitability momentum across all three businesses. Most notably, Shopee's growth is re-accelerating and the company is on track to be profitable by the end of the year, which could be a major catalyst for the stock. Furthermore, I believe C stock is still undervalued, and despite the recent rally that we've seen over the last few weeks, the stock is still down 85% from its all-time highs of $370. I'm not saying that the stock will reclaim its all-time highs. Maybe it will, maybe it won't. But what I do know is that the stock is still undervalued with massive upside potential, which is why I continue to hold a position in C Limited stock. That being said, I hope you enjoyed this video, and if you do, please don't forget to hit like and subscribe as it really helps with my channel. As always, I appreciate you guys, and I hope to see you in the next video.